Do you want to successfully complete the D196 Objective Assessment exam? Then you are in the right place. Our website provides a list of questions and answers for your success in the D196 OA exam for free. We understand that acing your OA exam can be quite challenging. That's why we provide completely free exam guides and practice questions for you. In this video, we will cover questions from costing methods, cost behaviour, budgeting concepts, financial statements and cost classification. So let's get started. 1. Which of the following describes a cost driver in a manufacturing setting? A. Direct labour hours. B. Raw material costs. C. Factory rent. D. Advertising expenses. What do you think is the answer? Correct answer, A. Direct labour hours. Explanation. Option A is correct because a cost driver is something that makes certain costs go up or down. In a factory, the more hours people work directly on making products, the more some of the factory's general running costs might increase. So direct labour hours can drive those overhead costs. Option B is incorrect because raw material costs are a direct cost of the product, not a cost driver. Option C is incorrect because factory rent is usually a fixed cost, not driven by activity levels in the same way. Option D is incorrect because advertising expenses are a selling expense, not a manufacturing cost driver. Two, what does a manufacturing overhead budget typically exclude? A. Factory utility costs. B. Direct materials. C. Indirect labour costs. D. Depreciation of factory equipment. Do you know the answer? Correct answer, B. Direct materials. Explanation. Option B is correct because manufacturing overhead includes all factory costs that are not direct materials or direct labour. Option A is incorrect because factory utility costs such as electricity are part of manufacturing overhead. Option C is incorrect because indirect labour costs, such as supervisor salaries, are part of manufacturing overhead. Option D is incorrect because depreciation of factory equipment is considered a manufacturing overhead expense. 3. Which of the following is classified as an operating expense? A. Raw material costs. B. Salaries of sales staff. C. Factory rent. D. Depreciation on production machinery. Do you know the answer? Correct answer, B. Salaries of sales staff. Explanation. Option B is correct because operating expenses are the costs a company has from its normal, day-to-day business activities that are not directly related to making the product. The salaries of sales staff are a good example of an operating expense, specifically a selling expense. Option A is incorrect because raw material costs are a direct cost associated with the production of goods. Option C is incorrect because factory rent is a manufacturing overhead cost, which is a product cost related to production facilities. Option D is incorrect because depreciation on production machinery is a manufacturing overhead cost, a product cost allocated to the use of equipment in production. 4. Which type of business is most likely to use process costing? A. Custom furniture manufacturer. B. Construction company. C. Cereal manufacturer. D. IT consulting firm. Do you know the answer? Correct answer, C. Cereal manufacturer. Explanation. Option C is correct, because process costing is a way to figure out product costs when a company makes huge amounts of identical or very similar products in a continuous flow. Like a cereal manufacturer, producing millions of boxes of the same kind of cereal. Process costing averages the costs over all the units produced in a period. Option A is incorrect because a custom furniture manufacturer would likely use job order costing because each job is different. Option B is incorrect because a construction company would likely use job order costing because each job is different. Option D is incorrect because an IT consulting firm provides services and would use a service costing system, possibly job-based. 5. Which financial statement reports a company's assets and liabilities? A. Income statement. B. Balance sheet. C. Statement of cash flows. D. Statement of retained earnings. What do you think is the answer? Correct answer, B. Balance sheet. Explanation. Option B is correct because the balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. It follows the accounting equation. Assets equal sign liabilities plus equity. Option A is incorrect because the income statement reports a company's financial performance over a period of time, detailing revenues and expenses to arrive at net income. Option C is incorrect because the statement of cash flows tracks the movement of cash both into and out of a company over a period of time, categorized by operating, investing, and financing activities. Option D is incorrect because the statement of retained earnings shows the changes in a company's accumulated profits over a period, including net income and dividends paid out. 6. Which of the following is a variable cost? A. Factory rent. B. Depreciation on office equipment. C. Wages of assembly line workers. D. Insurance premiums. Can you guess the answer? Correct answer, C. Wages of assembly line workers. Explanation. Option C is correct because a variable cost is a cost that changes in total depending on how much a company produces or sells. The wages of assembly line workers are often a variable cost because if the company makes more products, it will likely need more worker hours, and so the total wages paid will increase. Option A is incorrect because factory rent is typically a fixed cost, meaning it stays the same each month regardless of production levels. Option B is incorrect because depreciation on office equipment is usually a fixed cost, especially if it is calculated using the straight line method. Option D is incorrect because insurance premiums are typically fixed costs, remaining constant regardless of production volume. 7. What is the contribution margin ratio if the sales price per unit is USD 40 and the variable cost per unit is USD 25? A. 0.25, B. 0.375, C. 0.50, D. 0.625. Can you guess the answer? Correct answer, B. 0.375. Explanation. Option B is correct because the contribution margin ratio is calculated by dividing the contribution margin per unit by the sales price per unit. The contribution margin per unit is the sales price per unit minus the variable cost per unit, which is USD 40, USD 25 =USD 15. Option A is incorrect because it represents an incorrect calculation. It may be the result of dividing the variable cost by the sales price. Option C is incorrect because it represents an incorrect calculation. It may be the result of dividing the variable cost by the sum of sales price and variable cost. Option D is incorrect because it represents an incorrect calculation. It may be the result of dividing the sales price by the contribution margin per unit. 8. Which of the following costs is considered a period cost? A. Direct materials. B. Indirect labour. C. Sales commissions. D. factory depreciation? What do you think is the answer? Correct answer, C, sales commissions. Explanation: option C is correct because period costs are expenses that are not directly tied to making a product and are related to a specific time period. Sales commissions are a good example of a period cost. Option A is incorrect because direct materials are a product cost because they are part of the cost of making the product. Option B is incorrect because indirect labour is a product cost because it is part of manufacturing overhead, which is part of the cost of making the product. Option D is incorrect because factory depreciation is a product cost because it is part of manufacturing overhead, which is part of the cost of making the product. 9. Which of the following is classified as a product cost? A. Utilities for the company's headquarters. B. Marketing expenses. C. Raw materials. D. Sales commissions. Do you know the answer? Correct answer, C. Raw materials. Explanation: option C is correct because product costs are all the costs that are directly involved in making a product, such as raw materials. Option A is incorrect because utilities for the company's headquarters are considered administrative costs, which are period costs, not product costs. Option B is incorrect because marketing expenses are period costs associated with selling the product, not making it. Option D is incorrect because sales commissions are selling expenses, which are period costs, not product costs. In a job order costing system, how are costs assigned? A. Costs are averaged across all units produced. B. Costs are accumulated by job or batch. C. Costs are assigned equally to each product. D. Costs are based on sales volume. Do you know the answer? Correct answer, B. Costs are accumulated by job or batch. Explanation: option B is correct because a job order costing system is used when a company makes products that are unique or are made in specific, distinct jobs or batches. In this system, the company carefully tracks and collects all the costs for each individual job separately. Option A is incorrect because averaging costs across all units is a characteristic of process costing, not job order costing, which focuses on individual jobs. Option C is incorrect because assigning costs equally to each product does not reflect the varying resource consumption of different jobs in a job order costing system. Option D is incorrect because costs in job order costing are assigned based on actual resource consumption, not sales volume. What is the break-even point in units if the sales price per unit is $50, variable cost per unit is $30, and fixed costs are $100,000? A. 2,000 units. B. 3,000 units. C. 5,000 units. D. 10,000 units. Do you know the answer? Correct answer, C. 5,000 units. Explanation: option C is correct because the break-even point is calculated by dividing total fixed costs by the contribution margin per unit. In this case, $100,000 divided by $20 equals 5,000 units. Option A is incorrect because 2,000 units would not cover the fixed costs given the contribution margin per unit. Option B is incorrect because 3,000 units would result in a loss, as it does not reach the break-even point where revenue covers all costs. Option D is incorrect because 10,000 units would generate a profit, not the break-even point, since revenue would exceed total costs. 12. Which of the following costs is included in manufacturing overhead? A. Wages of factory workers. B. Raw materials. C. Factory supervisor's salary. D. Advertising costs. What do you think is the answer? Correct answer, C. Factory supervisor's salary. Explanation. Option C is correct because manufacturing overhead includes all the costs of running a factory that are not direct materials or direct labour. A factory supervisor's salary is an example of indirect labour. They are essential for production, but their salary isn't tied to one specific product. Option A is incorrect because wages of factory workers directly making the product is direct labour. Option B is incorrect because raw materials is a direct material cost. Option D is incorrect because advertising costs is a selling expense. (13) Which account would appear on a company's balance sheet? A. Sales revenue. B. Cost of goods sold. C. Depreciation expense. D. Accounts receivable. Do you know the answer? Correct answer, D. Accounts receivable. Explanation. Option D is correct because accounts receivable is money that customers owe to the company for goods or services they bought on credit. This is something valuable that the company expects to receive in the future, so it's considered an asset. And asset accounts appear on the balance sheet. Option A is incorrect because sales revenue appears on the income statement, reflecting the revenue earned over a period. Option B is incorrect because cost of goods sold appears on the income statement, reflecting the direct costs of producing goods sold during a period. Option C is incorrect because depreciation expense appears on the income statement, reflecting the expense recognised for the decrease in value of an asset over its useful life during a period. 14. What is the primary purpose of a cash budget? A. To forecast future sales. B. To determine product pricing. C. To manage cash inflows and outflows. D. To allocate manufacturing overhead costs. Do you know the answer? Correct answer, C. To manage cash inflows and outflows. Explanation. Option C is correct because a cash budget is a plan that helps a company estimate how much cash money it expects to receive and how much cash it expects to pay out over a certain period in the future. The main purpose is to make sure the company will have enough cash on hand to pay its bills when they are due and to manage its cash flow effectively. Option A is incorrect because forecasting future sales is the purpose of a sales budget, which is a separate financial planning tool. Option B is incorrect because determining product pricing involves market research, cost analysis, and competitive considerations, not a cash budget. Option D is incorrect because allocating manufacturing overhead costs is part of cost accounting and is used to determine the cost of goods sold, not to manage cash flow. 15. Which cost is considered a fixed cost? A. Raw material costs. B. Sales commissions. C. Monthly rent. D. Direct labour. Can you guess the answer? Correct answer, C. Monthly rent. Explanation. Option C is correct because a fixed cost is a cost that stays the same in total, no matter how much a company produces or sells at least within a certain range of activity. Monthly rent for a factory or office is a classic example. The company usually has to pay the same amount of rent each month, whether it makes 100 products or 1,000 products. Option A is incorrect because raw material costs are usually variable costs because they go up or down with the level of production. Option B is incorrect because sales commissions are usually variable costs because they go up or down with the level of sales. Option D is incorrect because direct labour costs are usually variable costs because they go up or down with the level of production. (16) Which of the following is an example of a direct cost? A. Utilities for the corporate office. B. Wages of assembly line workers. C. Depreciation on factory equipment. D. Advertising expenses. Do you know the answer? Correct answer: B. Wages of assembly line workers. Explanation: Option B is correct because a direct cost is a cost that can be easily and directly traced or linked to a specific product, job, or service. The wages of assembly line workers who are physically working on making the product are a direct cost, specifically direct labour, because you can figure out how much of their time went into making each unit. Option A is incorrect because utilities for the corporate office are considered an indirect cost since it's harder to assign them directly to one specific product. Option C is incorrect because depreciation on factory equipment is considered an indirect cost since it's harder to assign them directly to one specific product. Option D is incorrect because advertising expenses are considered an indirect cost since it's harder to assign them directly to one specific product. 17. What is the correct order of preparing budgets in a manufacturing company? A. Production budget, sales budget, direct materials budget. B. Sales budget, production budget, direct materials budget. C. Direct materials budget, sales budget, production budget. D. Production budget, direct materials budget, sales budget. Can you guess the answer? Correct answer: B. Sales budget, production budget, direct materials budget. Explanation: Option B is correct because when a manufacturing company makes its master budget, it usually follows a specific order. Sales budget first, then production budget based on the sales forecast, and finally direct materials budget based on how much you need to produce. Option A is incorrect because the sales budget must come first, as it drives the production budget. Option C is incorrect because both the sales and production budgets must come before the direct materials budget. Option D is incorrect because the sales budget is the foundation and must be prepared before the production or direct materials budgets. 18. Which of the following is a product cost? A. Rent for the corporate office. B. Factory utilities. C. Administrative salaries. D. Sales commissions. Do you know the answer? Correct answer: B. Factory utilities. Explanation: Option B is correct because product costs are all the costs that are directly involved in making a product in a factory. This includes direct materials, direct labour, and manufacturing overhead. Factory utilities are a type of manufacturing overhead, so they are a product cost. Option A is incorrect because rent for the corporate office is a period cost, not directly related to manufacturing the product. Option C is incorrect because administrative salaries are period costs, as they are related to the general administration of the company rather than direct production. Option D is incorrect because sales commissions are period costs associated with selling the product, not manufacturing it. (19) What is the break-even sales revenue if the contribution margin ratio is 40% and fixed costs are USD 120,000? A. USD 200,000. B. USD 250,000. C. USD 300,000. D. USD 400,000. Do you know the answer? Correct answer: C. USD 300,000. Explanation. Option C is correct because the break-even point in sales dollars is calculated by dividing total fixed costs by the contribution margin ratio, which in this case is USD 120,000 divided by 0.40, resulting in USD 300,000. Option A is incorrect because USD 200,000 would be the break-even point if the contribution margin ratio was 60%. Option B is incorrect because USD 250,000 would be the break-even point if the contribution margin ratio was 48%. Option D is incorrect because USD 400,000 would be the break-even point if the contribution margin ratio was 30%. 20. What does a statement of cash flows report? A. Revenue, expenses and net income. B. Cash inflows and outflows. C. Assets, liabilities and equity. D. Net income and retained earnings. Do you know the answer? Correct answer. B. Cash inflows and outflows. Explanation. Option B is correct because the statement of cash flows is a financial report that shows exactly where a company's cash money came from and where its cash money went during a specific period of time. It helps people see how the company is generating and using its cash. Option A is incorrect because it describes the income statement, not the statement of cash flows. Option C is incorrect because it describes the balance sheet, not the statement of cash flows. Option D is incorrect because it describes parts of the income statement and statement of retained earnings, equity, not the statement of cash flows. 21. Which budget helps a company determine how much inventory to keep on hand? A. Sales budget. B. Inventory budget. C. Production budget. D. Cash budget. Do you know the answer? Correct answer. B. Inventory budget. Explanation. Option B is correct because the process of deciding how much inventory to have and how much to purchase or produce to maintain that level is a key part of overall budgeting. This information feeds into the production budget and the direct materials budget. The concept of planning inventory levels is central here. Option A is incorrect because the sales budget primarily forecasts sales. Option C is incorrect because the production budget determines how much to produce based on sales and desired inventory levels. Option D is incorrect because the cash budget plans cash inflows and outflows. 22. Which of the following is classified as a current asset? A. Land. B. Equipment. C. Accounts payable. D. Inventory. What do you think is the answer? Correct answer. D. Inventory. Explanation. Option D is correct because a current asset is something valuable that a company owns and expects to use up, sell, or turn into cash within 1 year or within its normal business cycle. Inventory, the goods a company has on hand to sell to customers, fits this description because companies plan to sell it relatively soon. Option A is incorrect because land is a non-current long-term asset. Option B is incorrect because equipment is a non-current long-term asset. Option C is incorrect because accounts payable is a current liability, meaning money the company owes to others. 23. In which situation would a company use job order costing? A. Mass production of identical products. B. Production of custom-made goods. C. Continuous production of homogeneous items. D. Automated assembly line production. Do you know the answer? Correct answer. B. Production of custom-made goods. Explanation. Option B is correct because job order costing is a system used by companies that make products or provide services that are unique, special, or custom-made for each customer or job. Option A is incorrect because mass production typically uses process costing, which averages costs over large quantities of similar items. Option C is incorrect because continuous production of homogeneous items is better suited for process costing, not job order costing. Option D is incorrect because automated assembly lines usually produce similar items and benefit from process costing's efficiency. 24. Which of the following is an example of a non-controllable cost for a department manager? A. Direct labour. B. Sales commissions. C. Factory rent. D. Office supplies. What do you think is the answer? Correct answer, C. Factory rent. Explanation. Option C is correct because a non-controllable cost for a particular manager is an expense that they don't have the direct authority or ability to change or influence significantly, and factory rent is often a good example. Option A is incorrect because direct labour is often a cost that a department manager can have some control over through their decisions and management. Option B is incorrect because sales commissions are often costs that a department manager can have some control over through their decisions and management. Option D is incorrect because office supplies are often costs that a department manager can have some control over through their decisions and management. 25. Which type of business is most likely to use activity-based costing? A. A small bakery. B. A large electronics manufacturer. C. A custom furniture maker. D. A local retail store. Can you guess the answer? Correct answer, B. A large electronics manufacturer. Explanation. Option B is correct because activity-based costing is a more detailed and accurate way to assign overhead costs to products and works best in companies that have complex operations, make many different kinds of products, and have a lot of overhead costs that are driven by different activities. A large electronics manufacturer often fits this description because they might have many different production lines, many different products, and lots of varied support activities. Option A is incorrect because a small bakery likely has simpler operations where traditional costing is sufficient or activity-based costing is too complex to implement. Option C is incorrect because a custom furniture maker likely has simpler operations where traditional costing is sufficient, or activity-based costing is too complex to implement. Option D is incorrect because a local retail store likely has simpler operations where traditional costing is sufficient, or activity-based costing is too complex to implement. 26. What is the correct formula to calculate break-even point in sales dollars? A. Fixed costs. Contribution margin per unit. B. Fixed costs. Variable cost per unit. C. Fixed costs. Contribution margin ratio. D. Fixed costs. Sales price per unit. Can you guess the answer? Correct answer, C. Fixed costs, contribution margin ratio. Explanation. Option C is correct because the break-even point in sales dollars is calculated by dividing total fixed costs by the contribution margin ratio. Option A is incorrect because dividing fixed costs by contribution margin per unit calculates the break-even point in units, not sales dollars. Option B is incorrect because dividing fixed costs by variable cost per unit does not yield a meaningful financial metric. Option D is incorrect because dividing fixed costs by sales price per unit does not properly account for variable costs and the contribution margin. 27. Which of the following is considered a cash inflow from financing activities in the statement of cash flows? A. Paying salaries. B. Borrowing money from a bank. C. Purchasing equipment. D. Paying rent. Can you guess the answer? Correct answer, B. Borrowing money from a bank. Explanation: option B is correct because financing activities on the statement of cash flows show how a company gets its long-term funding and how it repays its investors or lenders. When a company borrows money from a bank, it receives cash, and this inflow of cash is a financing activity. Option A is incorrect because paying salaries is an operating activity, representing a cash outflow for day-to-day business expenses. Option C is incorrect because purchasing equipment is an investing activity, which involves using cash to acquire long-term assets. Option D is incorrect because paying rent is an operating activity, reflecting a cash outflow for the use of property in business operations. 28. What is the contribution margin per unit if the sales price per unit is USD 70 and the variable cost per unit is USD 40? A. USD 30, B. USD 40, C. USD 50, D. USD 70. Do you know the answer? Correct answer, A. USD 30. Explanation: option A is correct because the contribution margin per unit is the amount of money from each unit sold that is left over after you've paid for the variable costs of making that unit. Option B is incorrect because USD 40 is the variable cost per unit, not the contribution margin. Option C is incorrect because USD 50 does not represent the correct calculation of sales price per unit minus variable cost per unit. Option D is incorrect because USD 70 is the sales price per unit, not the contribution margin. 29. What does a predetermined overhead rate represent? A. Actual overhead costs incurred during production. B. Estimated overhead costs divided by an estimated level of activity. C. Direct labour costs divided by sales revenue. D. Fixed costs divided by total costs. Can you guess the answer? Correct answer, B. Estimated overhead costs divided by an estimated level of activity. Explanation: option B is correct because companies often can't wait until the end of the year to know their exact overhead costs to assign to products, so they calculate a rate at the beginning of the year by estimating total manufacturing overhead costs for the coming year, estimating the total amount of some activity base, and dividing the estimated overhead costs by the estimated activity level. Option A is incorrect because actual costs are used to compare to applied overhead, but the predetermined rate is based on estimates. Option C is incorrect because it's a ratio of direct labour costs to sales revenue, not related to overhead allocation. Option D is incorrect because it is a ratio of fixed costs to total costs, which is a measure of cost structure, not overhead allocation. 30. Which account is considered a liability? A. Accounts receivable. B. Inventory. C. Notes payable. D. Sales revenue. What do you think is the answer? Correct answer, C. Notes payable. Explanation: option C is correct because a liability is something that a company owes to someone else. It's a debt or an obligation. Notes payable represents money that a company has borrowed and has to pay back in the future, usually with interest. Option A is incorrect because accounts receivable represents money owed to the company by its customers, making it an asset. Option B is incorrect because inventory represents goods owned by the company that it intends to sell, making it an asset. Option D is incorrect because sales revenue represents money earned by the company from its sales, which increases equity. (31) Which of the following statements about fixed costs is true? A. Fixed costs decrease as production increases. B. Fixed costs remain constant regardless of production levels. C. Fixed costs increase in direct proportion to production levels. D. Fixed costs vary directly with sales. What do you think is the answer? Correct answer, B. Fixed costs remain constant regardless of production levels. Explanation. Option B is correct because fixed costs are expenses that stay the same in total amount. No matter how much a company produces or sells, at least within a certain range of activity. Option A is incorrect because fixed costs do not decrease as production increases. This is a characteristic of average fixed costs when considered per unit, not total fixed costs. Option C is incorrect because fixed costs do not increase in direct proportion to production levels. That is characteristic of variable costs. Option D is incorrect because fixed costs do not vary directly with sales. Sales volume is more closely related to variable costs and revenue. 32. What is the main objective of managerial accounting? A. To provide information for external users. B. To prepare tax returns. C. To help managers make informed business decisions. D. To prepare financial statements. Can you guess the answer? Correct answer, C. To help managers make informed business decisions. Explanation. Option C is correct because managerial accounting is all about providing information inside a company, specifically for the managers and other internal decision makers. This information helps them with things like planning future activities, controlling day-to-day operations, and making smart business decisions to achieve the company's goals. It's future-oriented and doesn't have to follow strict external reporting rules. Option A is incorrect because providing information for external users is the objective of financial accounting, not managerial accounting. Option B is incorrect because preparing tax returns is the objective of tax accounting, not managerial accounting. Option D is incorrect because preparing financial statements for external users is the objective of financial accounting, not managerial accounting. (33) What does a sales budget typically include? A. Projected sales revenue and units sold. B. Projected expenses and liabilities. C. Total fixed and variable costs. D. Production costs for the budget period. What do you think is the answer? Correct answer, A. Projected sales revenue and units sold. Explanation. Option A is correct because a sales budget is a company's plan or forecast for how much it expects to sell during a future period. It usually shows two main things: the number of units of each product the company expects to sell, and the total sales revenue it expects to earn from those sales. Option B is incorrect because projected expenses are included in an expense budget, and liabilities are part of the balance sheet. Option C is incorrect because fixed and variable costs are used in cost accounting and can influence the pricing strategy, but are not the primary components of a sales budget. Option D is incorrect because production costs are included in the production budget, which outlines the costs associated with manufacturing the goods to be sold. 34. Which of the following is an example of a mixed cost? A. Factory rent. B. Utility bills with a fixed charge and a variable charge based on usage. C. Direct labour costs. D. Depreciation on factory equipment. Can you guess the answer? Correct answer. B. Utility bills with a fixed charge and a variable charge based on usage. Explanation. Option B is correct because a mixed cost is a cost that has both a fixed and variable component. Utility bills often include a fixed monthly charge plus a variable charge based on usage. Option A is incorrect because factory rent is typically a fixed cost that does not vary with production volume. Option C is incorrect because direct labour costs are usually variable costs that fluctuate with the level of production. Option D is incorrect because depreciation on factory equipment is generally considered a fixed cost, especially if calculated using the straight line method. 35. Which of the following is an indirect labour cost? A. Wages paid to production line workers. B. Wages paid to factory supervisors. C. Wages paid to sales staff. D. Wages paid to administrative assistants. Do you know the answer? Correct answer. B. Wages paid to factory supervisors. Explanation. Option B is correct because indirect labour costs are wages paid to factory employees whose work is necessary for production, but who don't directly work on making the product itself. A factory supervisor's salary is a good example. They oversee the production process but aren't physically assembling the products. Indirect labour is part of manufacturing overhead. Option A is incorrect because wages paid to production line workers is direct labour. Option C is incorrect because wages paid to sales staff is a selling expense. Option D is incorrect because wages paid to administrative assistants is an administrative expense. 36. In a process costing system, how are costs accumulated? A. By individual job or batch. B. By department or process. C. By sales region. D. By customer order. Can you guess the answer? Correct answer. B. By department or process. Explanation. Option B is correct because a process costing system is used by companies that make large quantities of identical or very similar products in a continuous flow or through a series of standard steps or processes. In this system, manufacturing costs are collected and tracked for each separate department or production process that the products go through. The total costs for each process are then averaged over all the units produced in that process. Option A is incorrect because this describes job order costing, where costs are tracked for specific, unique projects rather than continuous processes. Option C is incorrect because sales regions are used for tracking sales performance, not for accumulating manufacturing costs in a process costing system. Option D is incorrect because customer orders are relevant to order fulfillment and revenue tracking, not the accumulation of manufacturing costs within a continuous production process. 37. Which of the following costs is considered a period cost? A. Wages of production workers. B. Raw materials used in production. C. Advertising expenses. D. Factory maintenance. What do you think is the answer? Correct answer. C. Advertising expenses. Explanation. Option C is correct because period costs are expenses that are not directly related to making a product. They are not product costs. Instead, they are associated with a specific time period and are usually expensed in that period. Advertising expenses are an example of a period cost. Option A is incorrect because wages of production workers are direct labour, a product cost. Option B is incorrect because raw materials used in production are direct materials, a product cost. Option D is incorrect because factory maintenance is manufacturing overhead, a product cost. 38. Which type of cost remains constant in total but varies per unit with changes in the level of activity? A. Fixed cost. B. Variable cost. C. Mixed cost. D. Stepped cost. What do you think is the answer? Correct answer, A. Fixed cost. Explanation: option A is correct because a fixed cost is an expense that stays the same in its total amount, no matter how much a company produces or sells within a certain range. The total is constant, but per unit varies. Option B is incorrect because variable cost is constant per unit, but its total varies with activity. Option C is incorrect because mixed cost has both fixed and variable parts. Option D is incorrect because stepped cost is fixed over a small range, then jumps to a new fixed level. 39. Which financial statement shows the total revenue and expenses of a company for a specific period? A. Balance sheet. B. Income statement. C. Statement of cash flows. D. Statement of retained earnings. Do you know the answer? Correct answer, B. Income statement. Explanation: option B is correct because the income statement is the financial report that tells you how well a company performed financially over a specific period of time. It lists all the money the company earned from its sales and other activities, and then subtracting all the costs and expenses it had to pay to earn that revenue. The result is the company's net income or net loss. Option A is incorrect because a balance sheet is a snapshot of a company's assets, liabilities, and equity at a specific point in time, not over a period. Option C is incorrect because the statement of cash flows shows the movement of cash, both into and out of a company, categorizing it into operating, investing, and financing activities. Option D is incorrect because the statement of retained earnings shows the changes in a company's accumulated profits over a period, reflecting net income and dividends. 40. Which type of company is most likely to use job order costing? A. A manufacturer of identical goods. B. A custom home builder. C. A cereal producer. D. An oil refinery. Do you know the answer? Correct answer, B. A custom home builder. Explanation: option B is correct because job order costing is a system used to track costs for products or services that are unique, made to order, or produced in distinct jobs or batches. A custom home builder is a perfect example because every house they build is different and has its own specific set of costs for materials, labour, and overhead that need to be tracked for that particular job. Option A is incorrect because manufacturers of identical goods typically use process costing to track costs for large quantities of similar products. Option C is incorrect because cereal producers typically use process costing to track costs for large quantities of similar products. Option D is incorrect because oil refineries typically use process costing to track costs for large quantities of similar products. 41. What is the variable cost ratio if the variable cost per unit is USD 10 and the sales price per unit is USD 25? A. 0.25, B. 0.40, C. 0.50, D. 0.60. Do you know the answer? Correct answer, B. 0.40. Explanation: option B is correct because the variable cost ratio is calculated by dividing the variable cost per unit by the sales price per unit, which in this case is USD 10 divided by USD 25, equaling 0.40. Option A is incorrect because 0.25 would be the result if the sales price per unit was divided by the variable cost per unit, which is the inverse of the variable cost ratio. Option C is incorrect because 0.50 would be the result if the variable cost per unit was USD 12.50 and the sales price per unit was USD 25. Option D is incorrect because 0.60 would be the result if the variable cost per unit was USD 15 and the sales price per unit was USD 25. 42. Which of the following is included in the cost of goods sold for a manufacturing company? A. Administrative expenses. B. Direct labour costs. C. Marketing expenses. D. Sales commissions. Can you guess the answer? Correct answer, B. Direct labour costs. Explanation. Option B is correct because the cost of goods sold for a manufacturing company includes all the direct costs that went into making the products that were actually sold during a period, including direct labour costs. Option A is incorrect because administrative expenses are period costs, not product costs included in COGS. Option C is incorrect because marketing expenses are period costs, not product costs included in COGS. Option D is incorrect because sales commissions are period costs, not product costs included in COGS. 43. What is the predetermined overhead rate if the estimated overhead is USD 50, 000, and the estimated labour hours are 10,000 hours? A. USD 5 per labour hour. B. USD 10 per labour hour. C. USD 50 per labour hour. D. USD 100 per labour hour. What do you think is the answer? Correct answer, A. USD 5 per labour hour. Explanation. Option A is correct because the predetermined overhead rate is used to apply manufacturing overhead costs to products or jobs. You calculate it at the beginning of a period using estimates. Predetermined overhead rate equals estimated total manufacturing. Overhead costs divided by estimated total amount of the allocation base, like labour hours. So USD 50,000 estimated overhead divided by 10,000 estimated labour hours equals USD 5 per labour hour. This means for every hour of direct labour worked on a job, USD 5 of overhead will be added to that job's cost. Option B is incorrect because USD 10 per labour hour would result from dividing the estimated overhead by 5,000 hours, not the actual 10,000 hours. Option C is incorrect because USD 50 per labour hour would result from dividing the estimated overhead by 1,000 hours, not the actual 10,000 hours. Option D is incorrect because USD 100 per labour hour would result from dividing the estimated overhead by 500 hours, not the actual 10,000 hours. 44. Which of the following is a direct material cost? A. Office supplies. B. Factory utilities. C. Steel used to manufacture cars. D. Wages of factory supervisors. What do you think is the answer? Correct answer, C. Steel used to manufacture cars. Explanation. Option C is correct because direct materials are the raw materials or components that become an integral part of the finished product and whose costs can be easily and directly traced to that product. Steel that is used to make the body or frame of a car is a clear example of a direct material for car manufacturing. Option A is incorrect because office supplies are usually an administrative expense. Option B is incorrect because factory utilities are manufacturing overhead. Option D is incorrect because wages of factory supervisors are indirect labour, which is manufacturing overhead. (45) Which of the following is classified as a current liability? A. Accounts receivable. B. Prepaid insurance. C. Notes payable. D. Land. Can you guess the answer? Correct answer, C. Notes payable. Explanation: option C is correct because a current liability is a debt or obligation that a company expects to pay off within 1 year or within its normal operating cycle, whichever is longer. Notes payable fits this definition perfectly. It's a formal written promise to pay a certain amount of money within the next year. Option A is incorrect because accounts receivable is money owed to the company, which is a current asset, not a liability. Option B is incorrect because prepaid insurance represents a future benefit, making it a current asset, not a liability. Option D is incorrect because land is a long-term asset, not a current liability, as it will provide value to the company for many years. 46. What is the break-even point in units if the contribution margin per unit is USD 25 and the fixed costs are USD 50,000? A. 1,000 units. B. 2,000 units. C. 2,500 units. D. 3,000 units. Can you guess the answer? Correct answer, B. 2,000 units. Explanation: option B is correct because the break-even point in units is calculated by dividing total fixed costs by the contribution margin per unit, which in this case is USD 50,000, USD 25 = 2,000 units. Option A is incorrect because 1,000 units would only cover USD 25,000 in fixed costs, leaving USD 25,000 uncovered, resulting in a loss. Option C is incorrect because 2,500 units would generate a profit since it exceeds the break-even point. Option D is incorrect because 3,000 units would also generate a profit, as it significantly exceeds the break-even point. 47. Which of the following is an example of a controllable cost for a department manager? A. Factory rent. B. Direct labour. C. Insurance premiums. D. Depreciation. Do you know the answer? Correct answer, B. Direct labour. Explanation: option B is correct because a controllable cost for a particular manager is an expense that they have the direct authority or ability to influence or change through their decisions and actions. A department manager can often control direct labour costs by managing how efficiently their workers are scheduled, how productive they are, or by controlling overtime. Option A is incorrect because factory rent is generally set at a higher level and not controlled by a department manager. Option C is incorrect because insurance premiums are often set company-wide and are not controllable by a specific department manager. Option D is incorrect because depreciation is based on past asset purchases and accounting methods, which a department manager typically cannot control. 48. Which account is considered an asset? A. Accounts payable. B. Common stock. C. Inventory. D. Sales revenue. Can you guess the answer? Correct answer, C. Inventory. Explanation: option C is correct because an asset is something valuable that a company owns and expects to provide a future economic benefit. Inventory, the goods a company has on hand that it plans to sell to customers, is an asset because it can be sold to generate revenue. Option A is incorrect because accounts payable, money owed by the company, is a liability. Option B is incorrect because common stock ownership shares is part of equity. Option D is incorrect because sales revenue, money earned from sales, increases equity. 49. What is an unfavorable cost variance? A. When actual costs are higher than budgeted costs. B. When actual costs are lower than budgeted costs. C. When sales exceed the break-even point. D. When fixed costs decrease during the period. What do you think is the answer? Correct answer, A. When actual costs are higher than budgeted costs. Explanation. Option A is correct because a variance in cost accounting is the difference between what was planned or budgeted for a cost and what the actual cost turned out to be. An unfavorable cost variance means the actual costs were higher than what was expected or budgeted, which is generally bad news for the company's profitability. Option B is incorrect because it describes a favorable cost variance, where actual costs are less than budgeted. Option C is incorrect because it refers to sales performance relative to the break-even point, not a cost variance. Option D is incorrect because it describes a change in fixed costs, not a comparison between actual and budgeted costs. 50. Which of the following is a period cost? A. Direct materials. B. Depreciation on factory equipment. C. Office rent. D. Direct labour. Can you guess the answer? Correct answer, C. Office rent. Explanation. Option C is correct because period costs are expenses that are not directly related to making a product. Instead, they are associated with a specific time period and are usually expensed in that period. Office rent for the company's administrative offices is a classic example of a period cost. Option A is incorrect because direct materials are a product cost because they are part of the cost of manufacturing the product. Option B is incorrect because depreciation on factory equipment is a product cost because it is part of the manufacturing overhead. Option D is incorrect because direct labour is a product cost because it is part of the cost of manufacturing the product. You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.